AFIC is one of Australia's largest listed investment companies, and they recently did a mid-year update in February of 2022 in terms of how their portfolio is operating. Now, I like listening to these updates for two reasons. First of all, AFIC seems to be, to me, quite a mature set of investors, and they're proper professional investors. And I like listening into how they see the market going, what kind of actions they're taking, what kind of interactions they're having with these companies. Always very handy to see and hear. The second reason is because AFIC accounts for now the third largest holding in my portfolio at about 15%. So obviously I'm going to be paying close attention to what they're doing with my money. So in this video, I'm going to do a quick summary of the presentation. It's about an hour long, the full one, and I'll leave links below. I'd encourage you to check it out if you have a second. But I'm going to do a quick summary and also share a couple of my thoughts and insights on it. So let's get into it. Now, one of the key slides they often throw up is this summary slide of how the actual portfolio and AFIC as a company is performing. Pretty standard stuff. As you'd expect, profit is starting to step up because we're now starting to exit COVID. The key thing for me was the 0.15% management expense fee has sort of stepped up a little bit. I'd keep an eye on that. They did comment it's related to them starting to set up their international trading team. Which I did do a video on actually some time ago. But look, the reason I kind of keep an eye on it because I compare AFIC's fee to what you'd be charged in terms of VAS, A200, IOZ, and it's still sitting a little bit higher than them. It's actually double an A200 type fee, but worth just watching closely. The fee does bump around a bit around that 0.1% mark. Another slide I often keep an eye on is this premium discount to the NTA that they often show of the actual AFIC share price against the underlying holdings. And what it's showing recently is it's sitting at around a 10% premium. What that means is you're effectively paying $110 for $100 worth of value. And there are times where it's been less, where you're paying $100 for $110 worth of value. But currently it's sitting at a bit of a premium. Now, you don't often see this with ETFs because I think they're designed to try and match the underlying value. Whereas with things like listed investment companies, because they're not issuing new shares each time you try and get in and out of it, it does tend to run into a premium or discount. I probably wouldn't buy AFIC, and I did talk about this in another video. While it's sitting at a premium, I'd pivot to something like a VAS or an A200 just to get that exposure to Australia without paying the premium of AFIC. One thing AFIC does like to do is obviously show off their performance, and they try to compare themselves to the ASX S&P 200 accumulation index. And they're showing here on the graph on the left where they're showing, we're consistently outperforming it. Fair enough. The graph on the right is something they've started to put out in recent years where they're trying to show basically volatility against returns, and they're trying to say AFIC generates higher returns than both the ASX 200 accumulation index and other funds out there while maintaining lower volatility. That's what that dot in sort of the top left quadrant is showing. Now, the whole volatility thing it's interesting. I think sometimes volatility is attributed to risk, and you think something that's very volatile might be very risky. And there has been talk from Warren Buffett in the past where he sort of said that's not the connection you should be drawing between volatility and risk. It's not the same thing. I'm also reading another book it's about Warren Buffett around the money mind and how he thinks. And there's a section in there a bit about volatility and risk. And I guess I'm not entirely sold on worrying too much about volatility. And there's that quote that I think Warren Buffett often has around, lumpy 15% returns against steady 10% returns. You'd always take the lumpy return. So I think AFIC here is trying to say we're not very volatile. And I understand if you're a investor and you need to keep your money around in the short term, or you need to potentially extract your money out in the short term, you don't want to be investing in something that's too volatile. But if you're investing over the next 20 years, having some volatility is not the end of the world because you're not going to try and realize those gains or those losses immediately. You're happy to sort of wait it out for another few years. So what I would like to see though in this chart is AFIC and something like VAS and A200, IOZ. I know AFIC doesn't see ETFs as a competitor, but I think the customer decides who your competitor is. And I think the everyday Australian will be looking at AFIC while also looking at ETFs. Wouldn't hurt if you threw an ETF in there. Although I think that's what the ASX 200 accumulation index is. I guess that's something like A200 with your dividends reinvested. So this slide I always enjoy hearing and seeing and sort of hearing the commentary on. And it's basically where they break down all the shares that they sold and completely got out of, things that they've trimmed, so they've not deleted their entire position or sold their entire position, they've just cut off a little bit off it. They've purchased new positions altogether, or positions where they've just added to things that they already had. And it's quite interesting because obviously they do quite a lot of research. They're trying to beat the top 200 companies, and they do it with only 60, 70 companies. So it's always interesting to see how they're deciding to slightly tweak in this direction or get completely out of this area. The two key things I saw here was they're obviously accelerating their exit out of oil and gas. So you can see they dropped APA Group, they've dropped Origin. They briefly touched on Woodside in the Q&A, how they will try and get out of Woodside, although they did try and defend the position saying, in the world of oil and gas, you have oil and gas, and oil is the really thing, the thing everyone's trying to get out of because it's related to cars and everyone's trying to go towards electrification of cars. In fact, when you look at how Woodside has performed over this year, 2022, against the rest of the share market, they're actually up about 27%, whereas the rest of the market's down around 5-6%. So I wouldn't be surprised if AFIC does use this recent geopolitical tensions, should we say, and the opportunity to exit Woodside and Santos while oil prices are up. The second thing I wanted to talk about was their purchasing of JB-HiFi and adding that to their portfolio, taking up a position in JB-HiFi. This rang a bit of an alarm bell for me because I thought, hang on, isn't JB-HiFi like one of the most shorted stocks on the Australian Stock Exchange? And I think I was right, but historically, you can see back in 2019, they had like a 15% short interest. Now, I did do a video talking about short selling and short interest and all of that in the past, but it's essentially when people take up a position in a company with the expectation that the company is going to go down in value and then try and profit off it. And you can see JB-HiFi has had a time when it was quite heavily shorted, but over time that's now dropped off, and understandable, the share price has also sort of recovered, and that could be a lot of the shorts closing out. So I can see now why, AFIC would take up a position in JB at least from a shorting point of view. They realize that interest has dropped off. They did say in their commentary they're expecting this as more of an income play. So they're not expecting capital gains, I guess, from JB-HiFi. They're just expecting a bit of a dividend income, nice steady stream to come through. So if you are also looking for steady dividend incomes, maybe consider JB-HiFi as well. Now we move on to Mark Freeman's favorite topic, ESG. You can tell by the way he talks about it in all the presentations. Historically, they haven't had a slide like this. They've talked about it in the Q&A. They've had a lot of questions around it, and I think they've now had to start adding a slide in. I was not personally blown away by this slide. This is the kind of slide you put together when someone says, hey, we need to put together a slide on ESG. Let's just say something but not commit to anything. And that's what you sort of see in the first 3 dot points. What are we seeing? Assessment of ESG factors is an important part of it. What exactly are you looking for? Is there a screening process? Nothing really said. We are long-term investors, so we seek to engage with companies that have strong governance and risk. But then you think about what happened with Rio Tinto. Did they have strong governance and risk when that happened? Well, yeah, okay. We regularly review companies to ensure ongoing alignment with our investment framework. Okay, look, I don't want to get into it because I think I've had a few shots at AFIC on this. All I'm saying is this is not very, I'm not seeing anything about, we're going to move out of coal. I'm not seeing anything about we're going to move out of oil and gas, although I can see the steps are being taken. Nothing about nuclear power, nuclear energy, firearms, social media, considering the international portfolio is also kicking off now. I would just say to AFIC, a little bit more effort wouldn't have hurt here, team. Then there's this whole section around engagement with companies. Now, you should be paying attention to this if you're an AFIC shareholder, just like if you're an ETF shareholder as well, is these companies are voting on your behalf because all the companies that AFIC owns will have AGMs. And in those AGMs, AFIC will use their voting position, which they got from the money we've given them as part of purchasing shares in them, or as part of our ownership of AFIC shares. They're using that and they're voting on our behalf. Now, they don't really ask us what we think, though. They do it by taking into account proxy reports and engaging with the companies directly. The thing, and I'll talk about this a little bit later, is I think we need a little bit more transparency with AFIC. if you're going to start saying that you're engaging with companies and you're voting and things, which way are you voting on issues? Which way are you going? I say this because we now live in a world where ETFs are often being compared with listed investment companies, or listed investment companies are being compared with ETFs. Whether rightly or wrongly, it's happening, Mark. I'm sorry. But what you got to figure out is look at what the transparency levels BetaShares has on some of their ESG-oriented ETFs. Okay, they are actually showing how they voted, and at times they voted against management recommendations. So look at this. These are some examples where they voted against what Apple's own management team said that they would do. Apple said, no, don't vote for this, and BetaShares did vote for it. And in the same way, at times, Starbucks said, don't vote for it. BetaShares decided not to vote for it. At least it's transparent. At least it's visible. At least everyone can see it. Are we now at the stage where if AFIC is going to start doing more in the ESG space, more than 6 dot points, let's just hope for, is the next step a little bit more transparency in terms of how votes have taken place or which way AFIC has voted? The other couple of things that came up mainly in the Q&A was a little bit about the international portfolio. It sounds like for now they're going to keep the international portfolio as part of the broader AFIC portfolio. But at some point they might consider, or Mark went through a bit of the criteria that they would consider before they would spin it out into its own portfolio. So I actually enjoyed that bit, worth listening to that in the Q&A. Then there was the usual question around lithium and rare earth companies and why isn't AFIC investing in it, or is AFIC looking into it? And it's, AFIC said it's currently expensive in its expensive space. Understandable, lithium is quite expensive and so are some of the rare earth companies. I think the key takeaway here is we're going to get a bit of a repeat of what happened with FMG. I don't think AFIC likes single commodity miners or narrow commodity miners. I think they prefer multi-commodity miners like your BHPs, like your Rio Tintos, that have large geological formations or large ore bodies that have 20, 30 years of mine life, low on the cost quartile. All of that stuff, that's what AFIC prefers. They don't like a company that just does one commodity and has a mindset that will only run for 10 years. I get it, but I think we're going to get these situations where it's going to be like FMG, where they missed it, they were too scared, they missed it, and then they got too expensive, and then they stayed out of it altogether. So hopefully, I don't know how they're going to get past this. I think they'll keep it on their shortlist. They'll wait for the lithium or rare earth prices to come down. And then they'll probably say, but it's too small a mindset, the ore body's too small, the cash flow is not going to be certain for the rest of, for a long time. Why would we invest in it? They don't pay dividends. So I don't know. I'm not expecting much from AFIC when it comes to this kind of single commodity miners. I look forward to their end of year update sometime in August, and I'll make sure I make a video on that. See you in the next video. Bye for now.